Well, hello everyone and good morning. Don't Stop Believing. I think that is a good song that we all need in this day and age. So welcome everyone to Back to the Business series, episode 6, when we focus on real estate and finance view. My name is Hilary Rand. I'm a partner at Think Hospitality as well as one of the co-founders of New Baltic Hospitality Forum. I will be hosting your session today. Who are we in the New Baltic Hospitality Forum team? We're 5 wonderful people, even if we say it so ourselves. And we came together some time ago wanting to really do something for the hospitality and hotel industry, specifically in the Baltics, to bring it together, bring great speakers, and provide great content to our industry. So we did so with our first forum that happened last year in April. We had 24 speakers and 204 delegates from 13 countries. It was a smashing event. We got great feedback. So of course, we wanted to continue on that trajectory. So we put an event together again for this year, but as we all know, the world has completely changed so this far. But we are really, really hopeful that in October we can still make the forum happen. Whether it will be partially digital and partially in person, we will see, because the times will tell. But please do keep an eye on our website, as we will be continually updating that, making sure we get the latest information to you. But in the meantime, we wanted to make sure that we talk about the issues, because there's so much going on. There's so much new information. Things are changing on a daily basis in world at large and in our industry specifically. So we put together supported by Enterprise Estonia and the City of Tallinn, a 7-episode webinar series called Back to Business, or in Estonian, Äri Ärataja, which we really like the name for. And we started with the kind of introduction, looking at numbers and the big picture. Then we moved into how to restart your team. We looked at product and service, to whom, why and how. We looked at cost and revenue management, because we know it's a price war out there right now for the business. Last week, the focus was on communication, and now we're on the real estate and finance view, and we'll have a epic final next week, looking at what's the path forward, talking about skills in the industry and leadership. So hopefully you will join us for that as well. And every episode, we have a wonderful sketch artist, Kati Orav, who puts together this infographic based on what has been said in the webinar. So this will be produced both in Estonian and in English, so you can share it with your team and with people in the industry. So these are kind of snapshot messages that our great speakers have communicated throughout. So these are all available on our website. And now to the session today. So we all know that finance and real estate is what drives a lot of this business, what we call hospitality, and especially hotels. And it's my great pleasure to have such an esteemed lineup of speakers today. Hopefully our technical issues will not be a problem, so fingers crossed. I will hand it over to Kimmo in just a bit, but first I would like to give the floor to Kaarel, who will take us through what has been happening in the markets, and give us a kind of a nice inlay into the rest of the discussion. So let's make sure, Kaarel, you're able to share. So I'm stop my sharing. So Kaarel, over to you.
Yeah, thank you. Thanks for having me and keeping fingers crossed for your October event. And as I only have 10 minutes that you spared, I will quickly kick off sharing my screen. Is it visible?
Yeah, perfect.
Right. Back to business. So I'm heading the stock exchange in Estonia, and I put together a few slides that don't. All right. I kick off with this 2 quotes, which I seem, for me at least, incredibly important in whatever time we live in, and also this very vibrant, let's call it like this. First is from Robert Schiller. I just finished his narrative economics. I suggested to everybody, basically. And he says that economics is not really about finance, which is very often the case, or the feeling we get. So it's a matter of people's behaviors and the narratives they use to describe whatever situation they live in. And the other one is from John Galbraith, who was, among other things, advisor to President Kennedy and a Harvard professor, etc., etc. He had, I think, quite a good sense of humor, being an economist himself, and said that there are two kinds of forecasters: those who don't know, and those who don't know they don't know. So probably didn't get much friends among his colleagues. The other thing he said is that the whole function of economists is to make astrology look respectable. This is basically my disclaimer, that I'm not going to give any forecasts in whatever formats. I'm just gonna, comment what I see. This slide is Standard & Poor's 500, and I showed this in January. Was it the beginning of February? There was a huge investment conference, and I wanted to make a point that making forecasts is, quite pointless. Here you can see very many famous, well-known either media or investment houses here who have since already 2012 given us a very gloomy picture that everything will fall apart. As you know, Standard & Poor's today, I haven't checked today, but last week at least, it was from its record state a few points. So there was obviously a crash. By the way, the crash was first used for a slump in the stock market in 1929. Before that, it was just falling or bumping or whatever. And then it was a crash, and it's basically this narrative from the Great Depression today. When the stock market falls, it's a crash, and the other one is a boom. Another picture. This is Nasdaq 100. And I just put a few names here that obviously are driving this. They are not the only one, but they are the leaders. This year, I think if we put TOPICL, I think Tesla, Zoom, and TOPICL have shown this year the biggest growth. And all in all, by the way, the Standard & Poor's also has these guys. Many of these biggest companies. So what we see here is that Nasdaq 100 has never been as high as it is today. It fell, some would say crashed, and now it's climbing again. Most driven by these, known to everybody technology companies. What I must say also, listed on Nasdaq, obviously. So what we are seeing here, and what we like to call it, is that what is investing all about? It's betting on a better tomorrow. There is a very old saying, I didn't want even to use it, but I still do. I think it has been used thousands of times, and it's a quote by Wayne Gretzky, that I go where the puck is going, not where it was. But there is this, why I didn't want to use it is that there's the flip side of the coin, that if everybody does it, then there will be a major, commotion going on. Gretzky was the best player. He could figure it out. But if everybody's running in one direction, it might, end up in something we call a herd instinct happening or a bubble happening. I'm not saying we are doing it now, but anyway, good to keep in mind. Mm-hmm. I stumbled upon an article by Taliban Spitsnagel, and he said there quite specifically that you have to quote me exactly. So this is what I'm doing here. It was called corporate socialism, and he was ranting on governments. It was I think it's April or something when the whole crisis just hit off. That the governments are bailing out the same they did 12 years ago. But he says that whoever calls this crisis a black swan, read my book, Black Swan. I leafed it through again. Yes, it's true. He actually means or mentions such kind of an epidemic happening. So basically, it's in his words, it's inevitable. It's unavoidable. And what he calls companies is that if there is only over-optimization without creating sufficient buffers, this will happen again and again and again. What I was and what I am still shocked actually is the reaction we saw. Not sure whether we have seen something like this in history or not, but basically the lockdowns, it was like a domino effect all over the world, and it still is, I think. Even when we are talking about the second waves or whatever. And I'm not sure. I'm starting to think that this lockdown might have been overreacting a little bit, especially when we think that, or for example, reflecting on the graphs I showed you, the indexes, right? So there is hardly an average business, which we humans like to have a very simplistic view and explain things very understandably. Even the most complex issues, but it's impossible. And this is also the case here, that there is no such thing as an average business. We might say that, of course, you have to adapt, and we can reflect on this old saying that it's not the most intelligent and whatever the second was, but the most adaptable who survives. But still, if you think that the economy is closed basically globally, that there are clearly some industries that are hit more severely with or without buffers. So there's just a question that how long should you be able to be alive with the buffers you create? And this overreaction, put this. Usually I show this in my college lectures, what happens with this herd instinct. And with this overreaction, what I don't like the most, I think, is this fear mongering and this panic, panic creation or so. I think talking about leadership, it's communication that is the most important tool, and I don't think we have had very good communication, along this pandemic. And I think it has created a fear situation that is not helpful or healthy in any way. And about overreaction is what we see in the financial markets and have seen for hundreds of years. So it's very, very difficult to find this equilibrium state. It's either overreaction or the opposite. And I put here just a few remarks that I have seen or have noticed a number of times in media. So there are black and white views, basically, what we are experiencing now. Some people say that everything will be different, and others say that we have to get back to normal, whatever this is, as quickly as possible. Then some take this Taleb's example that we need to shrink really down. We need to stop growing. We need to create buffers. The others say, again, linking to this back to normal, we need to grow at all costs. One thing I've heard, we need to go to a 6-day work week. The others say that we don't want to go back to work ever, right? So it's quite convenient. There's this overconsumption, overspending that has become a kind of a norm already. And there's the other extreme that we only start buying what is necessary. I don't know what the world will look like then, but anyway. And then climate. Does anybody remember that before this crisis, everybody was talking about the climate? Facebook was full of climate experts. Now they're full of epidemiologists and virologists and medical experts. And this is compared or opposing basically to productivity and growth, which I think it's complete nonsense. What I want to show is that there is always more colors, even if this slide doesn't or shows only black and white. And this is where the adaptability kicks in. Climate issues. The first clip or media clip is if you can see, from 2018. Larry Fink has been promoting this for a few years already, that in the next 5 years every investor will measure basically the company's value or impact to society with the ESG factors: environment, social, and governance. And this is what we see. And these are facts. I'm not forecasting, as I said in the beginning. The financials or basically the inflows into funds that are backed by ESG are the only ones that increased during the crash we experienced in spring. BlackRock is the biggest fund in the world with 7 trillion. So there was a 1 trillion outflow from BlackRock during the crash. And the only one that didn't suffer, actually got inflows, was ESG. So this is something that is not going away, that we see is happening. The funds are beating the so-called market. And however we deal, on government-wise, on company-wise, with this crisis we have on hand, we also have to concentrate on this. And what makes it more difficult is that we are talking about 1 trillion now in Europe that needs to fight the COVID crisis. I quite remember before the crisis, it was the same with the climate. It's a roughly 1 trillion needed. So it's huge amounts of money that needs to be printed, that have already. This graph stops at 2020 first quarter. I don't know where this red line or where the blue lines go, but it was already 2018. Economists and forecasters are saying that it's not sustainable. So this is, to make things more difficult or show more unclarity. This is something that is important on the background. And I will wrap up with this slide. I'm still remembering this narrative economics book, and that the whole point of it was, and I can share the slides, whoever wants, you can contact Hillary, and I'm more than happy to send them. But Robert Shiller draws a parallel between economic narratives and the pandemic. And it's interesting because the book was written in 2019. He says that the economic narratives, they follow very, very similarly the epidemic's curve. So there are people who spread word of mouth stories. Then there are people who are infected by these stories. And as long as they are infected, the narrative goes on. And he says that one of the most stable and still going strong narratives, exactly the business cycle narrative, that people are used to wait for a business cycle end in every 10 years, but not really backed by any science behind it. And the same with epidemics, right? So with this thought and with the unpredictability factor to all the economic narratives and also epidemics, I thank you all and wish you a great day.
Well, thank you, Kaarel. I think this was definitely a lot of food for thought for our attendees, and I'm now very happy to give over to Kimmo, who hopefully got some very interesting thoughts to lead the next session in. So thank you, Kaarel, so much for joining us. So I know it seems like we have 2 Gerhards, but actually one of them is Kimmo. So let me try to unmute one of you. Let's see. Just give me 1 second. There we go.
Does that work?
Yes.
Right. Well, good morning or good day, everyone, from me as well. And thank you very much for attending this webinar. The topic is very interesting from the point of view that obviously so many have been affected, especially in the hospitality sector, by this pandemic and the aftermath of it. And now we are all looking that, is there a light at the end of the tunnel? How do we get out of this? And what are we going to be experiencing during the period and before we hopefully get there? There was very relevant points made there by Kaarel about the sort of, how people perceive economy and what the impacts are. And no one seems to be having the crystal ball neither. Like ourselves working as a consultants, we obviously trying to predict and forecast what is going to be happening in the near future, and that task is quite difficult when we don't have any historical sort of reference points for something like this, although we have gone through many economic shocks and crises before. But that sort of leads into the topic to discuss what's the impact of all this into the hospitality sector and the hotel sector in particular. And I thought that we're going to be dividing the discussion slightly into two different sort of phases or parts. We are going to be talking about the existing businesses, and then we are going to be talking about, time permitting, a little bit about the future of the businesses or new businesses emerging in this market. And one of the big questions I've been asked many times is that what is going to be sort of, helping us to get out of this? And we sort of established three key points: that it's the physical restrictions, economic situation, and sentiment of the market that are sort of the key drivers of what's going to be happening going forward. But let's talk about a little bit about the existing business and sort of what impact has this had. I would like to open up with the sort of a question of what that, as there is very little that we can directly to do and help the industry. Has there been any sort of, helping hand lended by the investors towards the existing businesses trying to manage the situation and crisis? Can you, Pirjo, comment on that sort of, with your own company's experience and, what you have heard and seen from the colleagues, how the investors have been helping the tenants and the existing businesses during these times?
Yes, thank you, Kimmo. I'm Pirjo Ojanperä from CapMan Real Estate. I think the springtime was very tough for many operators, or you can say all operators in Finland and basically in all Nordic countries, and maybe we are talking about the whole world. The occupancy rate in April, I think that it was in Helsinki area 2%, and we had a huge growth until May or June, when it raised up to 8 or something like that. So that gives you the picture where the tenants were. And I do remember very clearly the Friday 13th of March when all this started, and I got the first phone call from one CEO of an operational company, and we started to think together what and how and when should we do. And I've been talking to many investors in hotel sector, and basically I think that all investors have been helping operators, giving time to pay, or giving discounts. It's very hard to pay your rent when your turnover is close to zero. Most of the hotels in Finland, all of them were closed for 2 months or more. Little by little, the business is getting back now, and we are very closely looking it together with other investors and especially together with the operators where this leads to, and we need to be together and very much awake to see where this leads to.
Okay, that's very sort of forward-looking and useful and helpful for the sector. Gerhard, do you have any experience from your side, from the operating side, sort of what has been the reception from the investors or the banks? Have they been lenient and lending helping hand, or have they been strict with the tough upper lip and say that you have to respect the agreements, or what's the experience?
Good morning, everybody. Morning, Kimmo. We've been lucky, I guess, in the sense that a lot of the banks, as well as our investors, have been lenient. They've been understanding, because I think this is, of course, everybody agrees, this is a once in a lifetime situation. that being said, I think I've never generated so many cash flow statements in my life. And that's the long and the short of it is that, you know, and this resonates also a little bit with what Kaarel said is, you know, there's no crystal ball right now, and the crystal ball is quite moggy. So it's a continuous discussion with the investors. You know, conditions changing dramatically on a day-to-day basis in the different markets that we do operate. And I think the main thing that the investors and sort of certainly the banks are also expecting from us is a form of agility. As operators, how agile are we? How quickly do we adjust the business model depending on whatever governmental support we get, or whatever changes there might be in terms of the cases. For instance, we have a number of hotels in Romania, and we've seen an influx in cases recently, and thus international travel has also kind of stopped a little bit into this country. And you know, the first call I got was from one of the investors: "What are you going to do? What is the outlook, etc." So we just need to be agile and sharp in terms of how we deal with this situation.
Okay. As everyone knows, the hotel business is very capital intensive, and it requires large investments in the beginning to get things going. And then even once you're going, then the biggest sort of priorities or fears with operating companies and investors is also repaying the loans and, you know, paying back, because if you try to maximize the return on your investment, so the companies tend to be also investing debt in these cases. So if I can ask from both Pirjo and Gerhard, sort of, what has been your experience with the banks? Sort of, have they changed their attitudes? Is this sector going to be like, you know, now being earmarked for doom and gloom, or do they still have a strong belief that, you know, it's fundamental, you know, inherited in our minds that people will travel? And what's the current view towards the sector as a whole?
Well, if I start, so I think that they are in the mood of, let's see how this leads to. Lyyti, I have a dog who is doing something she should not. Lyyti, hyvä. So I think that they are having a close look, and I think that this will be a little bit more expensive than it was a few months ago. Most of the investors and banks are very much aware of the situation, and they, yeah, as I mentioned, they look at it very closely. It's more difficult than it was 2019 or earlier, I think.
Yeah, I would agree with that. It is, I think they're not necessarily micro-analyzing, but they're analyzing, you know, each one of the investments bit by bit. But what I can tell you is that there's a number of younger, I would say maybe a little bit more aggressive, dynamic banks out there at the moment, which are looking at the more conservative banks and saying, okay, well, we see this as real estate opportunities and developments in hotels as an opportunity for us to potentially refinance other loans. And so we've been approached, and we've also spoken to a number of banks where, of course, the money is a little bit more expensive, as I'm sure you can appreciate, but the refinancing is maybe a little bit more attractive, and they're definitely more aggressive. So for anybody that is in this situation, I wouldn't say encourage you to go look at other banks, but don't be jaded by the larger institutions and their conservative approach necessarily.
Yeah, definitely. What we have been seeing is that you know, in the times like these, you know, being a severe shock to the economy or the market, banks tend to be pulling into the what we call like a turtle mode. You know, let's get all the arms in and just wait and, you know, weather the storm and see what happens, and lurking out of, is it gone by now or is it still there? But there also seems to be a tendency to be sort of a cautious behavior, sort of that if you have an existing loans, they can think of like, you know, should there be some repayment holidays, or should it be, you know, interest only periods, or like you said, Gerhard, restructuring the loans at the moment. And also, have you sort of seen also that the banks being sort of, you know, handing or granting additional loans covering sort of the running expenses, or sort of like opening the new lines of credit just to survive rather than modifying the underlying bigger sort of financial structures?
We certainly, if I just put this in perspective, a number of hotels that we opened last year. So you can imagine that these hotels are brand new. They were still kind of ramping up and also gaining working capital, if you can put it that way. And so we've had to turn to either investors or to banks. And yes, they've been very, I would say generous is maybe not the right word, but they've been relatively understanding. And what you sometimes find, of course, is that there is what banks want to see is that the investor would also put a little bit in there in order for the bank to have the surety that the investor has a belief in the longevity of the business. So we've seen this as in certain mechanisms that we've applied for as well. So.
Also,
I think that the whole industry is very much awake, because if I look at it from operators' side, so it's not very many banks who want to start to operate the hotels themselves.
Yeah.
So it's highly important that the operators will keep good condition and are alive also 2021.
Yeah, agreed.
Yeah, that is very much what we saw last time in the crisis during 2008 and 9, that banks were facing this very unfortunate situation that some businesses had got bankrupt and closed, and the banks ended up being the owners of some hotel operations and had to very quickly make decisions which ones to sort of, support financially and continue. Yeah. And then which ones to sort of, divest or otherwise seek a sort of rapid solution to it. This is maybe more for you, Gerhard, but also for Pirjo's comments. We've seen that not every hotel has yet opened after the worst part of the crisis. If we look at the Nordic regions, so some still remain closed. Mm-hmm. Sort of pondering what is the break-even point between, is it sensible to open and face the music and see where the demand is, or the other ones are calculating that we remain closed and save costs and just weather the storm in that way. Do you have any sort of feelings either for or against it?
So I can give you some indication what we're looking at. The point we're sort of looking at where we have a break-even point on EBITDA, if you wish, is roughly between 15 and 20% occupancy. Mm-hmm. Of course, there's a number of permutations you have to take into consideration, the size of the hotel. So if you have a, 60, 70, or 100 bedroom hotel, even this might not be the case, because you have sort of a base load of expenses on administration or undistributed costs. So, but generally speaking, if you're looking at 150, 180 to 200 bedroom hotel, around 15 to 20% mark is where we have this break-even point. What I would like to say though for us is what we've done is we haven't gone back to the traditional model of hotels. So we've just it's interesting. We've learned from Moxie, if you wish. We have a number of Moxies that we're now opening and this year. And they have a very interesting sort of model where, you have a crew member, which is a receptionist, but it's not only a receptionist, it's also a cook, it's also a waiter, it's also a barman and all this kind of thing. So we've adopted this model in our hotels. And of course, this drives profitability in the sense that it saves costs. Yeah. And it just makes the business far leaner. Again, it depends on what your layout is, how big your hotel is. Maybe you cannot do it if you have a monster hotel like some of the larger Radissons in the Baltics. Yeah, it's going to be hard to do. But really, I think it's about coming back to the agility and the mindset even of the team members. Just to say, okay, we want to keep this business alive. And if we want to have a break-even point where everybody has a job and we still, we're running towards this break-even point, you might have to do some things different than you normally would have. And that's it. And it's a team effort, I guess, in terms of reaching that point.
Yes, very much the sort of multitasking is one of the keys, and like in every business that the more flexible you can be, the better. Pirjo, any sort of experience or comments on topic?
Yeah, I think that it depends on market and it depends on operator. If the operator has a lot of properties or hotels in one market, for example, in Helsinki, and we all know that the business in Helsinki is not as good as it is in many other smaller cities in Finland, for example. So I do understand that it doesn't make sense to open all the hotels if you have 20 or so hotels in the market. So it makes sense to try to lead the customers to fewer hotels than you did before.
Yeah, there seems to be a tendency that the provincial hotels, mainly catering for the leisure market, are doing at the moment much better than the corporate driven or so hotels in sort of more urban concentrations like, you know, capitals, secondary cities and all that. I'm just concerned about the current impact and sort of the view that will this have some long-lasting impact or otherwise for the investors towards this sector, that would they consider seeing this more risky business or more risky sector than some of the other sectors that banks are and institutions are lending to? So have you, Gerhard, yet had any sort of discussions where this type of changes in the view or opinion would have come forward?
Yeah, certainly. Naturally, and I think this is human nature. Some people are a bit more conservative than others. And it also, I think it stems from the initial intention of the investor. So, you know, you have investors that want to go into a hotel business and get the hotel up and running, maybe get some sort of a track record and exit within 2 years. And of course, if this is your intention right now, this is not necessarily the business that you want to be in, because, you know, that track record that you're going to build up in the next 2 years is going to take maybe a little bit longer. Yeah. So on the other side of the coin, you have investors which are in it for a little bit more of the long haul, and they see the bigger picture that this is a blip on the radar. And, you know, if you stick to it, the long game is going to be the better game. So for us, obviously, we tend to lean towards the latter as opposed to the first in who we partner with. But the main thing is, I think that, yeah, you will have people that are a bit more conservative and a little bit more skittish to invest right now. It's up to you as an operator or as a co-investor to convince them this is a long-term game.
We definitely seen the sort of, you know, I wouldn't say it's a change of mode or view, but people getting more cautious. Yeah. And some banks have indicated that the hospitality sector has gone from green to amber to say, we go case by case. We may only finance the existing clients and, you know, not so keen to do new business and things like these, and then maybe reviewing some of the loan conditions and you know, criteria. Let's use this as a bridge to talk about some developments, because the fundamental there is the view of the investors and the lenders towards the sector and the long-term impact that this crisis may have. Although many, as you are aware of, look at the hotel investments as a long-term 10 to 20-year sort of periods. And if we have now crisis, which we hope to go away in a year's time or two, obviously has some impact in the long-term calculations, but shouldn't be the whole of it. And, you know, we will prevail, we will come back at some point. The question is just when. But that may have an impact on sort of on the banks that, you know, is the sector still attractive? Why or why not? And, you know, what are the lending criteria? Pirjo is not yet back by his screen, but Gerhard, have you seen any discussion like shifts in the key criteria like loan to value ratios or interest rates recently? Have you been exposed to these conversations?
Yeah, we have. I think what we're seeing now is that there's certain criteria that the banks are trying to incorporate. Certainly, if we're looking at some new investments or some refinancing situations where they're looking to incorporate different criteria that we would have experienced in the past, you know, certain at least minimum performance clauses, or sometimes, it's mainly related to performance clauses related to how we do in our market and how we manage our GOP and all this kind of stuff, which it's almost becoming like similar to a management agreement. You know, you have like a performance clause in there. And this is something that we haven't experienced before, and it's fair enough, because I think the banks are also cautious what the covenants are that they put in place in order to make sure that this investment is secure for them. Yeah. So this is there's definitely a change that we've seen.
Yeah, it's unfortunate situation on that basis that the hotel sectors definitely have been looked at the sort of the most difficult real estate sector to understand from the fundamental point of view, because it's doing with operating real estate rather than just passive fixed cash flow, and hence banks have a less desire or interest to look into it, maybe depending what type of specialism they have developed within the bank. And like you said, they may be tightening some of the criteria, like, some ratios, interest rate cover ratios, loan servicing ratios and all that. But also, I guess, more sort of developing the sense that they are insecure of looking into the future. So they may be requesting additional people to look into these projects. For example, cash flow forecast. It may be that it's not anymore only source is the client, rather than maybe looking for third independent parties' views, valuers, consultants also, stepping in and looking how they see the market, the cash flow, looking like additional security for the decision-making process.
What we've seen, sorry to interrupt, please carry on.
Go ahead.
So this is a very valid point, and specifically one of the banks that we are dealing with right now, they have brought an expert on board, so they have a hotel development person working for them as such, and this person is then obviously intimately involved in terms of due diligence processes, analyzing the markets, and it's a different discussion, because you're dealing with an industry peer and an industry expert in terms of how you position your property and what the forecast will be for the future and so on.
Yeah, I vividly remember the 2008 crisis as an example for some of the listeners. The UK actually commissioned several consultants and brokers from Christie and Co. to help them out to weed out what needs to be kept, what needs to be let go. And, banks were facing unprecedented situation of sort of real estate coming in that they became owners of in a very short period of time. Also, what we have seen that they very picky potentially to look at what type of developments to fund. So, it may well be that sort of the luxury segment may be seen as the most risky at the moment, whereas then the more limited service sector may be looked at less risky, although still in their minds risky, but less so. So it has an impact also what type of project one is proposing for them to finance, and on what level and for what period. One important thing is the issue that I have had to discuss with many people, saying that it's the type of contracts and then branding versus no branding. Because at the moment, we have seen that lease contracts have not necessarily prevented people from feeling the crisis. So it also is an issue that you're not necessarily safe with a lease. You may have felt so, but this just proves the fact that when the storms really hit the market, then no one is safe, so to speak. But it's also how to prepare for these type of things in advance, as they seem to be coming, like Kaarel was saying, roughly around every 10-12 years or so. Have you had any discussions lately about sort of the benefit of branding or sort of management contract versus lease discussions with the banks or investors?
If I may, yes, of course. I mean, the brand in itself has a major kudos to it, from different respects, in the sense that we see, certainly in our core brands that we have now, sort of Marriott and Hilton, that the pickup has been pretty decent. They have a certain amount of loyalty customers, which they promote to quite aggressively and communicate to. And that's when you come to the end user or the customer, they're much more sure that, for instance, in this case, you have the cleanliness scenario. I know a number of hotel branded companies such as focus tremendously on what they do from a hygiene perspective and how they communicate that with the customer. So if you have a loyalty base, then this, from a brand perspective, of course, is far more interesting for the investor and also for the bank. But the one thing that we have seen is, as opposed to leases, maybe, is what is the guarantee that you are willing to offer as an operator. And of course, now in this day and age, these guarantees are few and far between, right? Because nobody knows necessarily what's going to happen in the next 12 to 18 to 24 months. So everybody's quite reluctant to give some form of guarantee. But what is interesting, certainly from a third-party operator perspective, is that if you are not in a position to give a guarantee, what happens is that there's sort of a hybrid. There's a hybrid thing that's coming out now from investors, where they say, fine, if you can't guarantee it, we'll be the back end of that guarantee for you. So that at least when I go to the bank as the owner, and I need some form of investment in my building, I have an operator that's a guarantee, regardless of whether I'm the back end of that guarantee or not. And it looks good for the bank, and at least there's some kind of an agreement. So this is an interesting hybrid that's coming out at the moment.
Yeah, and also we've seen also operating models that we call triangulars, where you have the direct relationship between the investor and then the bank, and then sort of the bank is being protected, or that we try to provide additional guarantee in the form of that someone will pay serving the debt, or there is at least cash flow coming in, that the third-party independent operator who may have also a brand is being protected with an idea that should something go wrong with that operator and they face situations where they cannot continue operating the premises themselves, then the brand operator or the brand itself starts to operate the hotel under sort of like an emergency agreement or so for the lender, so that the property is at least producing cash to partially serve the debt until more permanent solution will be found. So we try to find different ways to protect this one. Then finally, before getting to the closing remarks, is that also how we've seen this to be affecting the pipeline. So many larger markets have obviously a number of proposed hotel developments taking place, and some of them are still on the planning department's desks to be decided will they get the building permits or not. And what we've seen is that there has been both delays and cancellations in the Baltic market, and you know, the next few months will definitely have more an impact on this decision-making process, is to see what will progress and what will not. What has been your experience so far, Gerhard? You know, have you put any your projects completely in cancellation, or is it just a question of delays?
It's a question of delay. I would say about 30% of our projects have been delayed, more on the investor side. And then, as I mentioned before, maybe a conservative investor or a conservative bank, or some sort of restrictions that are preventing them from proceeding. But on the contrary, we've also seen that a number of new projects have come online, where people are, and it's maybe, I'm going to say speculative if you wish, but that are looking for distressed assets, and they're moving quite quickly. In addition to that, is that what we've seen in some other markets, for instance, in Hungary, as an example, the building cost has come down dramatically in the last couple of months. So these investors and these developers are taking this into consideration, and they're actually trying to push new developments through in light of the fact that the total cost for them would be lower, as opposed to what was in the past, or what they foresee maybe in the next 24 or 48 months. So yeah, so for us, I would say it's, yeah, there has been some decline or some slowdown, if you wish, in certain cases, about 30%, but there's definitely a lot of new hope, some cash flush guys out there that want to build hotels.
Well, it's like every unfortunate situations like this, they always have challenges also, but they also create opportunities for those who can move and, you know, make decisions and have access to funds and so forth. In terms of recovery, I did mention earlier the three sort of, you know, key areas that we've seen, you know, to feature in many discussions about the Nordic region and the Baltic region is that one of them is the access or the physical access to the markets. And if we don't have much of barriers to travel, borders are open and things like that. So that is obviously supporting the market from that point of view, that yes, it is possible to move. And you know, in that way, travel to markets and markets to recover. Another one is the economical situation, which in the Baltic countries and the Nordic has been relatively good in comparison to some other countries, to weather and, you know, the storm, you know, what type of blow it takes for additional debt lending for the governments. And so many Baltic governments have had really low sort of debt ratios to GDP in that way. And then also the proportion of the hospitality industry representing of the overall GDP is relatively low, because this high correlation between the economic recovery and the hospitality sector recovery, that if the economy doesn't recover, so hospitality sector doesn't cover neither. And we are in a way in an unfortunate situation in that way, that the hospitality sector is not driving the GDP. It's part of it, but it's not driving it, like in, for example, countries, Italy, Spain, and others, where the proportion is tremendous. So they have much more difficulties to get the economy going if the hospitality sector is not functioning properly. And then maybe finally is the sentiment that Kaarel was also referring to, that, people are still, at the end of the day, group of psychological behavior. So when everyone talks about recession, people start believing about recession, and there's some similarities in these terms, that more information is needed to keep the conversations and observations sort of fact-based. But again, the sentiment seems to be good. People are still quite positive about the economies. Number of people affected by the COVID-19 virus are relatively low in this region. So all those sort of support the idea that the recovery should be on its way. There's fundamentals are supporting it. Now it's a question of how many people believe into it and start behaving in a supporting way. But looks like that the investment in lending still will be challenging. So it remains to be seen within the next couple of months what direction the market is going on when the summer period and the domestic demand is on its peak now, but will naturally become slightly lower in September, October time. So that will definitely be the test of time to see what the recovery is and where we are heading. But again, would be interesting then to see and hear more from people in terms of questions or comments, what the experiences are, and get in touch with us to discuss further these matters. But I think that will be all from us now for this webinar, because we are heading towards the end of our time limit. So I would like to thank the panelists, Kaarel, Pirjo, and Gerhard, and giving it back to Hilary.
Well, thank you, Kimmo. You always do such a great job bringing everyone together and asking the relevant questions. So thank you so much for moderating this part of the webinar. And we will have the recording up on the website by tomorrow morning. Make sure you do go and listen. We'll have the infographic up there, as well as and the slides from Kaarel if you're interested in those. So do just keep checking our website. And we are going to have our last episode in a week's time. It will be about what is the path forward. We're going to talk about skills, education, leadership, and a big picture view. So do come back and listen. I know it's holiday time, but we have about 180 people showing interest in these webinar series from around the region. So thank you so much for tuning in, and thank you to our partners, Enterprise Estonia and the city of Tallinn. So see you all next week for the last episode. Thank you to all my speakers and panelists. It's been absolutely great having you on, and do keep checking back to our website, and we'll see you for the next session. And last one for now, next week. My name is Hilary Rand. Have a great summer.